All right. Today is Monday, November 1st. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. Let's get right into it. In focus tonight, we're going to talk about the Deere Strike and the implications on the long-term outlook for inflation. And then we're going to talk about a segment we call Senile Leadership. And lastly, the insane options mania in Tesla. We start with the UAW strike against Deere, and here are the developments. Over the weekend, Deere offered workers an immediate 10% gain in wages right away. That deal was struck down and it was not accepted. Labor has the power now, and they're exercising their power to demand higher wages and higher benefits. This will increase the input cost for companies, and in turn, they will raise prices on us, the end consumer, to compensate for wage inflation. This is how inflation works. It spirals out of control. It has ripple effects, and this is what the Federal Reserve, led by Jerome Powell, doesn't seem to understand. The 10% offer was struck down right away, and we had another tragedy that perhaps added more pressure on Deere to revise their offer and come back with a better offer for the UAW members. The news that we got, the tragic news that is, John Deere workers struck and killed by car while walking to the picket line Wednesday. And here's the update. John Deere doubles wage increases, boosts retirement benefits in a second offer to striking UAW workers. And now they're agreeing on a 6-year contract. And this is, of course, subject to a union vote. But the take here is, this is a 6 years contract, meaning the wage increases will continue on and on for 6 years. So when the Fed says inflation is transitory, when the Secretary of Treasury says that inflation is transitory, when the President of the United States says that inflation is transitory, they're absolutely out of mind, they're delusional. They lack the basic understanding of how inflation works. This will not be transitory. A contract for 6 years, ensuring 5 to 10% increases in wages, will seal the deal right here and then that inflation is not transitory and prices will continue to move higher and higher and higher. To compensate for wage increases, Deere will have to increase prices on their equipment. Farmers will have to pay more for the equipment. Matter of fact, we have used tractors selling for more than they were new. But the bottom line is Deere will raise prices on their equipment. Farmers will have to pay more, and farmers will pass the extra cost that they're paying for the equipment on us, the end consumer, for the food that they produce. This is how inflation works. It has a ripple effect, and unfortunately, our senile leaders lack the basic understanding of how inflation works. Speaking of, here it is, the segment we call Senile Leaders. You might have heard that the president's approval numbers are dropping like a rock, to the point that we have a crisis ongoing right now at the White House. The drop in approval ratings for Joe Biden year to date since he assumed office is the largest drop in history. No other president experienced such drop in history, and therefore we have a crisis mode right now at the White House. And according to the latest polls, when Americans are asked, what is the most important problem facing the U.S. today? The majority, 22%, say the economy, unemployment, and jobs. Not the climate, not the woke stuff, not cow farts, not going to Mars. The number one issue remains the economy, stupid. Across all party affiliations, the number one issue remains the economy, employment, and jobs. Across all party affiliations, when asked, is the country going in the right or wrong directions, 87% of Republicans say the country is in the wrong direction. A stunning 64% of independents say that the country is in the wrong direction, and 38% of Democrats also say that the country is in the wrong direction. All in all, 60% of all Americans say that the country is on the wrong track. And we have this fiasco, the circus over at Washington, D.C. right now. They're not passing the bill. They're passing blames against each other. The corporate wing of the party versus the Republican wing of the party versus the socialist wing of the party. Everybody's passing the blame and nothing is being done. They, of course, are blaming the progressives, the Bernie Sanders wing. And I already explained to you that Bernie Sanders already folded. Bernie says, I don't care about Medicare or eyeglasses. Just throw in free lunch and you got a deal. On the other hand, we have the de facto president of the United States, Senator Joe Manchin, who played a cute trick today, saying that the infrastructure bill should be passed separately than the so-called reconciliation bill. He will vote for the infrastructure bill. He will not vote for the reconciliation bill. Take a look.
First of all, I want to thank you all for coming. And I've heard a lot of the mischaracterizations of my position since the President met with the House Democrats last Thursday, and I would like to make an attempt to clear up any confusion about where I stand on the legislation that's working its way through Congress. In all of my years of public service, and I've been around for a long time, I've never seen anything like this. The President of the United States has addressed the House Democratic Caucus twice recently to urge action on the bipartisan infrastructure bill, which sometimes we refer to as the BIF bill. Last week, the Speaker Pelosi urged the importance of voting and passing the BIF bill before the President took the world stage overseas, and still no action. In my view, this is not how the United States Congress should operate, or in my view, has operated in the past. The political games have to stop. Twice now, the House has balked at the opportunity to send the BIF legislation to the President. As you've heard, there are some House Democrats who say they can't support this infrastructure package until they get my commitment on the reconciliation legislation. It is time to vote on the BIF bill, up or down, and then go home and explain to your constituents the decision you made. And I've always said, if I can't go home and explain it, I can't vote for it, and if I can, I will. I've worked in good faith for 3 months, for the past 3 months, with President Biden, Leader Schumer, Speaker Pelosi, and my colleagues on the reconciliation bill, and I will continue to do so. For the sake of the country, I urge the House to vote and pass the bipartisan infrastructure bill. Holding this bill hostage is not going to work in getting my support for reconciliation bill. Throughout the last 3 months, I've been straightforward about my concerns that I will not support a reconciliation package that expands social programs and irresponsibly adds to our $29 trillion in national debt that no one seems to really care about or even talk about. Nor will I support a package that risks hurting American families suffering from historic inflation.
And let me decode this clown for you. He says I'm okay with infrastructure. I don't want to increase inflation. I don't want to increase extra spending that is not needed. That's all baloney, of course. His end game is not to raise taxes on his billionaire donors. That's all there is. The infrastructure bill will be funded by the increases in taxes in the reconciliation bill. If the infrastructure bill passed on its own, then guess who's going to pay for the infrastructure spending? The answer is average folks, not the billionaires, not the rich, not the corporations. So he is playing this cute game. I got your interest in mind. I don't want to increase inflation on you guys. Baloney, you're just protecting your own donors from extra taxes. Somebody gotta pay, and you don't want it to be your donors. And here we have another senile leader in Janet Yellen, the Treasury Secretary, who issued some delusional statements. For example, she said, "I would not say the U.S. economy is really overheating." Here's another one. America is still 5 million jobs below where we were pre-pandemic. Labor force participation likely due to pandemic and lack of child care. More workers will rejoin labor market if pandemic fades. So again, this is yet another attempt to put a lipstick on a pig and say, you know what, the problems we're having right now with the supply chain and inflation, the labor shortage, these are all due to the pandemic and the lack of child care. And if you allow us to pass this crazy spending, problem solved. Oh, and by the way, all of the spending is already paid for. You don't have to worry about anything. You don't have to worry about your taxes going higher, funding secured. Really? Are we that delusional? Take a look.
I have said that these plans will add to growth and be stimulative for the economy. Any sense of how much and for how long?
Well, I think that it really helps us invest in physical capital, that's public infrastructure, that's important to productivity growth. There's investment in people or human capital. There's investment in research and development, and the supports that families will receive that will help them participate in the labor market, that will boost labor supply. All of those things boost the economy's potential to grow. To my mind, certainly over the long run, over a decade, several tenths of a percentage point.
Will it drive up short-term inflation even more?
No, I don't think that these investments will drive up inflation at all. First of all, they're fully paid for. Not by imposing higher taxes on anyone earning under $400,000, but by asking corporations, high-income individuals to pay their fair share, and by investing in the Internal Revenue Service so that they can boost compliance, which is fallen to low levels. We have a huge amount of uncollected tax revenue, a tax gap that's estimated at $7 trillion over a decade.
And then Yellen went on to defend her criminal buddy Jerome Powell, supporting an extension of his tenure, his tyrannic tenure, to continue to destroy the economy in favor of stock market gains and real estate gains for the rich. Put the money printer on steroids. Who cares about the national debt? Who cares about inflation? Everything is under control. Just trust us. Rest assured. What are you worried about? When she says funding is secured, how is it secured? You delusional, mad person. To secure the funding for all of this spending, you have to increase taxes on corporations and the rich. Well, you have members in your own party, Manchin and the likes, who are already paid for and sponsored by the same billionaires you're trying to raise taxes on. The billionaires say, we're not going to pay extra taxes. Forget about it. The corporations say, we're not going to pay extra in taxes. Forget about it. So who is going to end up flipping the bill? I think you and I know the answer. Take, for example, senile billionaire Leon Cooperman, who hates the wealth tax and says there is no sympathy for billionaires and that the ultra-wealthy are being attacked for no reason. Cry me a river. You've been enjoying this criminal system, this rigged economy for years and years and years. And now when you're asked to pay your fair share, all of a sudden you're nowhere to be found. Again, the man is almost 80 years old. He has one foot in the grave, but the greed and the ego lasts forever because they're going to take the money, the billions of dollars to the grave, right? Here's another greedy billionaire, the richest man on the planet right now, Reverend Elon Musk, who says Biden is a UAW puppet. He's attacking Biden because Biden will pass EV tax credits for Ford and GM, the union companies. Meaning, if I'm shopping for an EV and I have a choice between a Model 3 and the Ford Mach-E, I will get a discount up to $12,000 on the Mach-E versus the Tesla Model 3. This will, of course, favor Ford and GM. Ford and GM have union memberships. They pay their taxes. They pay their dues. On the other hand, greedy billionaire Musk doesn't pay taxes at all. Pays zero. His company is not a union company. And if you leave it up to these greedy billionaires, here's an example of what's going to happen. The UN says $6 billion from the world's billionaires could solve a hunger crisis. Elon Musk says he will sell Tesla stock and donate proceeds if the UN can prove that. They're going to sit in their high tower with the billions of dollars stolen from the public and say, you know what, you want it back? You want us to pay taxes on the stolen money? Prove it to us. I say, you know what, bring the guillotine and force them to pay taxes. Because at the end of the day, all of this fake wealth is created by stolen money. The Federal Reserve launched the quantitative easing program and printed trillions and trillions of dollars out of thin air, adding all of that to the national debt, which the next generation of Americans will have to deal with, the Gen Zers and the likes. All of that fake money, the majority of it at least, floats all the way back to the stock market, pushing equity prices to hyper-bubble territory. For example, pushing Tesla stock to the stratosphere. Billionaire Elon Musk gets richer by free money printed out of thin air, adding to the public debt. He did not produce anything. He did not create more jobs. He did not create products and services to justify the increase in market capitalization for the stock. The justification is all of that fake money is now floating back to the stock market in gambling and speculations, pushing stocks valuations higher and higher and higher. The billionaires in turn, they cash in, they sell stocks, or they take loans like Elon Musk does. They take billions of dollars worth of loans, hedging those loans with their ownership in the equity. And oh, by the way, when they pay interest on those loans, those payments are deductible, meaning they get tax credits on every penny they pay in interest for the loans they receive. They take billions of dollars worth of loans. They can fund new companies. They can buy homes. They can buy yachts and jets and everything they want. Tax-free. Ask yourself a question, by the way. Is this capitalism or is this crony capitalism? Is this gangsterism? Is this a broken system or not? If we're going to pass a massive infrastructure bill and a massive, insane spending bill, isn't it the right thing to make the billionaires who enjoyed this rigged system and the fake money printed out of thin air, isn't it time for them to give back some of that fake money in taxes? After all, you did not earn the money and the extra wealth. You stole it from the public. And even former Treasury Secretary Larry Summers, who served under the Clinton administration, and by the way, been spitting a lot of knowledge as of late. I don't know what's going on with Larry, but he's been spitting a lot of truth as of late. And Larry Summers says the tax plan that they have right now that Janet Yellen describes as already paid for will give rich people like him a big cut. Larry Summers says this is a scam. They're going to pass tax cuts on me and my billionaire buddies. So who's going to end up paying for all of this crazy spending? The answer is you and I. On top of inflation, which is already an added tax on the poor and middle class, now you're going to have to fund all of the infrastructure and the other crazy spending on top of that. And of course, the propagandists at the media, now they're also putting a lipstick on a pig and telling us, you know what, everything the administration promised you, well, you're not going to get that right now. It's okay. It actually strengthened the case for it to be passed in the future. Wow. Are we really that stupid, folks? Here's the headline from the New York Times. Why the demise of family paid leave will actually fuel it later on. Wow. Just wait for it. Be patient. Lower your expectations, folks. You're gonna get it later. Baloney. Every civilized country in the world has paid family leave with exception of this country. Yet you're not going to get that either because your senile leaders put the interest of billionaires and corporations, the stock market, the real estate market ahead of your own and the country's interest. It's a swamp. It's a whorehouse. What's new? And here we have the Secretary of Transportation, who's not senile yet, but he is channeling his inner senile. When asked about the crazy spending, he says it will actually lower inflation. Take a look.
Say that instead of focusing on these issues, that the president and Democrats in the House and Senate should be focusing on the issues that Americans care about most. You mentioned one of them in your first answer, and that's inflation. Gas prices have jumped from $2.14 a gallon a year ago to $3.41 now. Natural gas prices have more than doubled. And Mr. Secretary, in September, consumer prices rose at the fastest pace in 30 years. So instead of, I'm not denying or denigrating some of these social policies, but that's what Americans are most concerned about is inflation.
I'm so glad you raised this, Chris. This is extremely important. This bill will fight inflation. The reason this bill will fight inflation, among other things, is that we have a drag on our economy in labor supply because a lot of parents aren't going back to work because they can't find childcare. Now, you're going to see some politicians, maybe even on this program, saying that up is down and black is white, and somehow saying the opposite. But let me be clear. This bill will fight inflation. And when I say that, that's not just me as a representative. Hold on, this is very important, Chris.
Well, here's the problem, Mayor Pete. The problem with this inflation in this economy, with the supply chain woes, inflation, and the labor shortage, this is all due to the printing of money, the insanity of the liquidity. Trillions of dollars floating all over the place, exploding the demand way out of whack, way out of control, and the supply will not be able to keep up with the demand. When you say that this is a crisis due to child care, if we pass billions of dollars in spending for child care, the problem will be solved. Again, you're making a mockery of our intelligence. Is the labor shortage in truckers due to moms staying at home, taking care of the children? No, it's not. Don't get me wrong. I might be supportive of that, but it doesn't solve the problem. The problem is the out-of-whack demand. To solve this problem, extra spending to so-called alleviate the supply chain crisis by expanding the ability the supply chain will only continue to increase the demand higher. The gap between demand and supply is the problem. Extra spending might expand the capacity of supply, but will also expand the demand higher and higher and higher. To alleviate the inflation problem, we need to shrink the demand. We have to control the demand. And if history taught us anything, to keep demand under control and give the supply side the time needed to catch up with the demand, you have to lower the demand You have to push the demand down. And the easiest way you can do that is monetary tightening, not extra spending. Ask yourself a question. Is the Fed tapering enough? Of course not. Is the Fed even considering raising interest rates? Of course not. The Fed is waiting and waiting and waiting to be reactive. This is the disaster in the making. The Fed will not react by increasing interest rates higher until inflation gets out of whack and we have hyperinflation in this country. And then we have to face massive recessions just like we had in the late 70s, early 80s. What they can do right now, this moment, is for the Fed Chairman Jerome Powell to have the humility to understand the situation and say, you know what, inflation has exceeded our expectations. It is not transitory. And therefore, we have to start a gradual increase of interest rates. Yes, the market is not going to like it. The real estate market will perhaps crash. The stock market will perhaps crash. But in the grand scheme of things, you're going to save the economy from hyperinflation and out of whack inflation. You're also going to save the stock market from a historic crash. You're going to crash it maybe 20-30% right now, but it will recover in the years to come. If you wait and create the hyperinflation crisis, well, guess what? The market will crash either way, but that crash will exceed 60-70% top to bottom and will probably create a recession, a crisis not seen since the Great Depression era that could last for years, if not decades. And this leads us to the last subject of the commentary today, which is the Tesla options mania, the clearest illustration of this excess liquidity in the system. When people have extra cash, they're what to know what to do with, and they're using this cash to gamble in the stock market casino. Look at what's going on with Tesla stock, exploding higher. This is a company that is worth over $1 trillion. We're not talking about a penny stock. We're not talking about a meme stock. We're talking about one of the largest components of the S&P 500 and the NASDAQ. What will happen if this is just a pump and dump? Are we going to have mom and pops holding the bag and perhaps the stock crashes after the mania? This will have a massive impact on the S&P and the NASDAQ. And I explained to you last night that this mania in Tesla stock is driven by options gambling. And here's yet another so-called analyst, an expert, supporting my thesis.
Chris, we have talked many times about Tesla's role in the macro market, how it's so big, there's so many shares, so much options activity, that it matters even if you don't own Tesla stock or could care less about the company. What are you seeing with Tesla right now that is so interesting?
Good morning, Brian. There's so many things that are so interesting going on in Tesla right now. It was up over 22% last week. We had humongous options volumes that traded. And that was all reported, great, made for some great headlines, how many options are trading compared to the broader market, things like that. I do think one thing that was somewhat overlooked last week was comparing that options volume on a daily basis to how much open interest changed the next day. So basically what that's telling you is, let's look at, for example, on last Monday, almost 2.5 million calls traded, which is a huge number, largest since the stock split last year. But the next day, open interest only changes by 120,000. So that's about 5%. So basically what that's telling you is, despite all that options call volume that's trading, the next day, only about 5% of that volume carries over to new positions. So, around 95% of that options trading on a daily basis is both opened and closed, whether it's bought and then sold or sold and then bought. But these are very, very short-term trades. So, that's going to not have quite as much of an impact as, consistent buying that builds up every single day.
Now, what is he talking about? He is talking about the options grid in Tesla. What we're seeing right now is people buying options out of the money call options. They're trading them at the same day. They're buying an insane amount of call options. They open them in the morning, they close them by the end of the day, lather, rinse, repeat. You see, the open interest is not that high, but the volume is exploding higher. This mania started by somebody buying the 900 call options out of the money. The stock exploded higher. Then they rolled out all the way to the 1,000 call options. The stock continued to explode higher. And then they rolled up to the 1,100 calls last week, and the stock exploded higher, reaching the 1,100 strike. Now they're rolling all the way to the 1,200 calls, and the stock moved higher all the way to 1,200 and beyond. Tomorrow, they're going to roll to 1,300. They're going to continue to do the same thing over and over and over again until the whole thing explodes and the stock crashes back. This is the magic of implied volatility. It continues to go on and on and on until it becomes not worthy anymore to chase the mania. What am I talking about, by the way? Look at the options grid. The stock moved higher by over 8% today. The 1200 calls, for example, appreciated by over about 250% today, which is an enormous gain, but yet it pales in comparison with the gains that we got last week on Monday. Same move produced over 2,000% gains. Now those gains shrunk all the way down to about 250%. As the implied volatility continues to rise higher and higher and higher, options premiums will also appreciate higher and higher and higher. And buying call options out of the money will become extremely expensive. Therefore, these gains will shrink from 2,000% to 250%, all the way down to 80%. 60%, even though the stock is exploding higher by the tune of 10%. And then it becomes less worthy. The risk versus reward doesn't make sense at all. And the rally, the so-called rally, frizzles out. And there are going to be victims at the top. The mom and pops who bought the hype, who don't understand what I'm looking at right now, what you and I are looking at right now, and they buy the stock and get caught at the top and they end up holding the bag. This is the jungle that we call the stock market right now. And of course, the SEC is nowhere to be found. They remain in a coma. Mind you, these gamblers are not buying the stock. They're not interested in the long-term price action in the stock. These are weekly options expiring on Friday. And as you will see in the options market coverage in a minute or so, that they're spending millions of dollars on call options, put options that expire by the end of the week. This is the reckless insanity fueled by money printing and the excess liquidity in the system. And the speculation mania goes on. The article reads, "It is becoming tempting to try timing the bubble again, with stocks at a record and Tesla topping a $1 trillion valuation. This seductive, though near impossible idea is regaining currency." What is he talking about, by the way? If we go back to the 1990s, the dot-com bubble, shorting the market in 98 and 99 was ahead of time, meaning that you shorted early and you were holding a bag. But in the long term, it paid off because the market crashed. So you're not going to be able to time the market. You're not going to be able to time the market crash. But the author is suggesting that perhaps we're going to see the same phenomenon, the same speculation mania of picking the top and timing the top. And it might not be a bad idea anyways. Because here is an illustration, for example. They're using the ratio of the Russell 2000 Value Index by the S&P 500 information technology sector, which was the core and the source of the bubble and the mania in the 1990s. Value has been underperforming growth throughout the dot-com bubble. If you bought growth and bet against the information technology back in 99, you've been eating pies day after day after day, as stocks, specifically the speculative mania stocks, in tech, growth, the dot-com names, been riding higher and higher and higher. But after the crash in March 2000, value started to outperform growth significantly. Therefore, if you shorted ahead of time by rotating the value versus growth, at the end of the day, you were proven right. The problem this time around, even value is no longer value. What does that mean? Even value is in bubble territory. This is the everything bubble, the everything mania. In white, the Russell 2000 Value Index price to sales ratio back in the 1990s. In blue, the Russell 2000 Value Index price to sales ratio today. As you can see, in 99 all the way to 2000, the Russell 2000 Value Index remained at value. If you bought it back then, you were rewarded in the long term. Right now, even value is in bubble territory, which suggests that perhaps this time around, we're not going to see the phenomenon of the bust of the dot-com bubble, where the NASDAQ crashes, yet the Dow Jones, the value names continue to outperform. Perhaps everything will crash together, just like we saw back in the 09 crash. Now, when we revisit the dot-com bubble and apply the poster boy for the bubble we have right now, Tesla, how does it compare with the dot-com bubble? Cisco, Qualcomm, Amazon. Can Tesla follow Amazon, the article says? Question mark. This brings us to the phenomenon of the age, Tesla. No company has ever reached $1 trillion valuation on such small revenue. Its market cap takes an immense amount of success in the future for granted. As I said yesterday, it is possible to imagine a version of the future in which today's price looks like a good deal. There are far more futures in which Tesla looks like a disaster. Returning to the lessons of 2000, great companies can be terrible investments. The unfortunate object lesson came from Cisco Systems Incorporated, briefly the world's largest company, and in 2000 the dominant provider of internet's physical infrastructure. Remember back in the dot-com bubble when everybody says you gotta buy Cisco, don't pay attention to the valuations. The future is the internet, and the internet will not exist without Cisco. Remember that? A few weeks ago, Cisco hit its first high since 2000 before dropping back. Anyone who bought at the top 21 years ago is still sitting on an outright loss. Bear in mind that Cisco was a successful company. It is still powerful, and the internet grew about as much as the greatest optimists hoped. The problem was that even this did not justify paying a multiple of 46 times revenue. The stock now trades at 4.6 times. This provides the easy bear case for Tesla. Yes, it is a great company. And yes, electric vehicles are the future, but you still don't want to buy at this price. Just look at Cisco. In blue, Cisco price to sales ratio. In white, Cisco's price action. It took 21 years to recover the prior highs in the dot-com bubble, meaning if you bought at the top, you've been waiting for over 21 years for the stock to catch up with the valuation. And the stock, of course, crashed down. After that, you've been sitting on a loss for about 21 years. Notice that the price to sales ratio peaked in the dot-com bubble mania, and then it came down. It took 21 years for the stock to grow to its valuation back in 2000. And this is exactly what's going to happen to Tesla. The reply is just look at Amazon.com. These, of course, are the Tesla culties. This is still an even bigger company. Like Tesla, Amazon.com also has a CEO who fires himself into space in a rocket built with his own spare change. And it is also was the subject of one of the craziest investment manias in history. The crucial point for Tesla culties is that for those with patience, it actually made great sense to buy Amazon at the top of its first bubble. How entitled was someone in 1999 to see that coming? At that point, Amazon was a loss-making but popular online bookstore that had started selling other goods. Many other people were also trying to sell stuff online and attracting plenty of capital. It wasn't even clear that Amazon would emerge as the dominant internet retailer. After all, at that point, the most popular search engine was Alta Vista. By 2009, Amazon had seen off its competition and shown the ability to make a profit. It had also dipped its toe into hardware by offering the Kindle electronic reader. And as you can see, the price to sales ratio for Amazon peaked in the 1990s mania, and then it went down. It took years and years and years for Amazon to live up to the valuation that it had before. Tesla had the same mania. The price to sales ratio popped higher, and then it started to go down and down and down as the company's revenues and growth started to catch up with the valuation. The problem is the price to sales ratio in this mania, the COVID-19 mania, has popped up higher again. What does that mean? It means that the company has to expand its revenue and growth to extremes to catch up with the valuation once again, meaning that having $50 billion in revenue will not be enough to justify the current price to sales ratio. Sales will have to expand to $100 million in revenue per year to justify the current valuations. It is very hard to come up with any justification for this. Microsoft Corporation highest ever sales multiple was 18, and Facebook Inc. and Google, now Alphabet, topped at 22. In all cases, they had one big peak and subsequently moved to something more sustainable. For Tesla to justify its current valuation, it needs to innovate and dominate well into the future in a way that more than matches Amazon. That is a big risk. More alarmingly, Tesla is that rare example of a bubble that bursts and then reinflated. Bitcoin is another. When two such phenomena come along at once, the most likely explanation lies in the conditions and psychology surrounding them, not in Tesla and Bitcoin themselves. This is a psychology-driven mania. The companies are working hard with the excess liquidity, with the capital raised from the mania to live up with the expectations, to live up with the valuations. But when you have the price-to-sales ratio expanding again to mania territory, in Tesla, for example, the company will have to deliver even more. And at some point, it becomes impossible for the company to live up with the expectations. Oh, and by the way, if somebody contacts you and says they are Elon Musk and they're offering you some Bitcoin scams, it is probably a scam. Facebook just verified a fake Elon Musk account that is pumping cryptos. This is the environment and the mania we're in. You cannot look at this and say, this is a normal market. This is not a bubble. This is different this time around. You gotta be a fool to think that this is different this time around because of tech or because of retail involvement in the market. We had the same conditions, the same exact conditions back in the 1990s. The mania is even more extreme and obscene this time around. Just take a look at a meme coin called Squid Game, named after the very popular Netflix series. Well, Squid Game coin popped higher, gaining over 230,000% before dropping back all the way down to zero, erasing all the gains. Of course, we now know that this is a scam. The scammers walked away with $2.1 million. The scam was so obvious before buying the coin. The deal was you can buy, but you cannot sell. And people bought anyways. Wow. Folks, this is not sustainable. This is an extreme mania, delusional mania, and the subsequent crash will be historic. Anyhow, we spent a lot of time here. Let's move on to the market's coverage, starting with the performance today. And here we go. The Dow Industrial Average closed in the green by 94.28 points, or a gain of 0.26%. The Nasdaq also closing in the green by 97.53 points, or a gain of 0.63%. The S&P 500 also closing in the green by 8.29 points, or a gain of 0.18%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, consumer cyclicals, aka Tesla. At number 2 for the silver, energy. At number 3 for the bronze, industrials. The only lagging sector of the market today is communication services, aka Google. And what about the advance to decline ratios? For the NYSE, 78% advancing versus 20% declining. The Nasdaq, 76% advancing versus 21% declining. A lot better than last week. Moving on to futures, what's going on here? This is Inflation Central, right here and there. Gasoline prices popping higher. Crude oil prices also gaining. The WTI gaining about half a percentage point or so. Natural gas prices in the U.S. are down about 4%. But bear in mind that European gas prices, natural gas prices in Europe, continue to rise higher and higher and higher. And if the winter forecast shows cooler temperature than expectations, then we're going to have a massive problem here, and natural gas prices will explode at a whack. If you thought this is crazy, hold your horses, buckle up your seatbelts, because it's about to get even crazier. We're all going to channel our inner Al Roker in the next few weeks. When it comes to grains futures, we have gains for wheat, oats, corn, and soybean oil futures. By the way, somebody brings up the chart of oats and show that chart to Jerome Powell. It's not just the insanity of money printing causing this inflation to surge higher. It is also combined by the climate crisis, destroying crops across the world, and wheat, oat prices are surging out of whack. We have losses in grains, led by canola, soybean meal, and rough rice, all closing in the red, while soybean futures pretty much at the flat line. What about meats? No activities here. Lean hogs and live cattle futures pretty much on the flat line, while we have some losses in feeder cattle futures. What about metals? The dollar is yo-yoing back and forth, anticipating the statement from Jerome Powell on Wednesday. The dollar went down slightly today, off the highs of the day, I should say, and therefore metals prices, metals futures are excited, at least for today. We have gains for platinum, palladium, gold, copper, silver, all closing in the green. Lastly, what about softs? The insanity, the explosion in cotton future prices continue to go on and on and on. Do yourself a favor and pull up the chart of cotton. Unbelievable. Cotton prices adding 4% gains today alone. We also have gains for coffee, cocoa, sugar, and OJ, while lumber future lost about 3% today. Moving on to the big casino, the options market. What's going on? The hottest table in the casino remains Tesla, with about 1.7 million contracts exchanging hands today. About 63% of those were calls. And at number 2, Apple, with about 1 million contracts. About 71.5% of those were calls. And at number 3, the ticker LCID, Lucid Motors, with about 700,000 contracts exchanging hands today. About 70% of those were calls. And watch out for the implied volatility, by the way. I look at the IV percentage, which means how does the current implied volatility stands against the historic highs in implied volatility. Take, for example, Tesla. Remember when that number was 0, And I told you, why are they not buying Tesla options? They're really cheap. Well, now we know the answer. They're buying on steroids. But in a nutshell, the IV percentage means that the current implied volatility in Tesla is above 65% of days during the last year. The current implied volatility is higher than 65% of all days in the last years in terms of implied volatility. Now, when the IV percentage reaches extremes, such as 99%, 96%, as we're seeing in Lucid right now, it is usually a sign that the stock will pull back from the move that's been going on. So if the stock been riding higher, it will do the opposite. If the stock been dropping down and the implied volatility reaches extremes, then we're about to have a rebound. In the case of Lucid, you're seeing the stock already softens, and the reason is the implied volatility reached extremes. The current reading is above 96% of days in terms of implied volatility in the last year. Now, you have to place things in perspective, by the way, because you could look at AMC, for example, and say, you know what, the IV percentage at around 10%, it is cheap, I should buy call options right now. Bear in mind that the IV 1-year high in AMC was over 500%. So of course, the current IV percentage will pale in comparison. This works for established stocks, so will not be good even for Lucid. Not so accurate for Lucid, but it is good for Ford, Tesla, Apple, AMD, Meta, etc. I also want to present you with the options grid for Lucid, for example. Notice that this is the same mania with Tesla. The stock is not moving higher because people are buying the stock or they believe in Lucid or we have good fundamental news for Lucid. This is an options gambling mania. They're buying these call options out of the money and they're closing them at the same day. They're not even carrying on the open interest. Nobody's interested in holding these options, not even for 1 day. It's a pump and dump, lather, rinse, repeat. And here is the options grid for Tesla, just if you missed it in the intro of the video. Similar story here. The volume is exceeding the open interest, meaning these call options have exchanged hands multiple times during the day. You buy them in the morning, you dump them in the afternoon, you dump them by the closing bell, doesn't matter. But they've been exchanging hands in the same day multiple times. And the same, of course, is happening with Facebook. As you can see, they're buying call options out of the money. They're not carrying on these call options in open interest in the next day or beyond. They're buying them the same day. They're closing them perhaps few minutes or hours in the same day. Moving on to the unusual activities that took place in the options market today, starting with the ticker LCID, Lucid Motors. The mania goes on, but remember this, somebody's buying these calls and somebody else is selling them. In this case, somebody bought the $40 calls for the expiration date, you guessed it, this upcoming Friday, November 5th. With expectations that Lucid could pop higher by more than 9.5% by then. They paid about $1.35 apiece to enter this trade. All in all, spending about $10 million. Of course, on the other side of the trade, the market maker is selling these calls, receiving $10 million, assuming that the stock will not make it to 40 by the end of the week. And then we have multiple trades for the SPY. We're just going to cover one of them, the 380 puts for the expiration date December 10th, with expectations that the SPY could drop down by more than 17.5% by then. They paid about 55 cents apiece to enter this trade, all in all, spending about $2.5 million. What about the ticker TSLA for Tesla, the souffle? They're buying puts here. They continue to buy puts. Total insanity. They're buying the 1,130 puts for the expiration date, you guessed it, this upcoming Friday, November 4th, with expectations that Tesla could drop down by more than 6.5% by then. They paid about $14 apiece to enter this trade. All in all, spending about $18 million. Continuing with unusual activities. What about the trade for the ticker IGT, International Gaming? The stock is exploding higher. Perhaps this is the next gamma squeeze, and they're buying the 39 calls, expecting more gains to come. The expiration date, November 19th. With expectations that the name could pop higher by more than 22% by then. They paid about 50 cents apiece to enter this trade. All in all, spending about $500,000. What about the trade for the ticker IWM, the Russell 2000? They're buying puts to the 221 puts for the expiration date November 12th, with expectations that the IWM could drop down by more than 5.5% by then. They paid about 55 cents apiece to enter this trade. All in all, spending about $500,000. What about the trade for the ticker BB, BlackBerry? They're buying the $12 calls for the expiration date December 3rd, with expectations that the name could pop higher by more than 5.5% by then. They paid about 90 cents apiece to enter this trade. All in all, spending about $800,000. Lastly, what about the trade for the ticker RUN? RUN in this trade, the ticker run for Sun Run. The name has exploded higher in the last few weeks in anticipation of the so-called spending bill. We could see the buy the rumor, sell the news phenomenon because somebody's buying puts here, the 55 puts for the expiration date, November 19th, with the expectations that the name could drop down by more than 5.5% by then. They paid about $2.25 a piece to enter this trade. All in all, spending about $1.7 million. Moving on to the heat map analysis. What's going on here? Mixed action all over the place, but we have weakness, significant weakness in the big cap technology names, Microsoft, Apple, Google, and Amazon especially. We're having Meta, Facebook, and Tesla moving via options. We have the Chinese names moving also via options in anticipation of Alibaba's earnings this week. Let's dig in deep for the movers of the day. For example, when we zoom into the auto manufacturers, they all did pretty good today. Tesla, Toyota, Ford, NIO, Xpeng. And of course, we have some news for some of these names. For example, Xpeng came very close to record monthly deliveries in October, and therefore the stock is moving higher. The problem is NIO disappointed. Chinese EV maker NIO's deliveries dropped 65% as supply chain issues manufacturing changes bite. They delivered only 3,667 vehicles in October. This is down more than 65% from September. Yet the stock moved higher anyways because we have an EV mania right now. And here we have another one. Revvion Automotive will be listed in an IPO. This is an Amazon-backed EV, and it will excite more mania in this market. Now, some of the other notable movers, for example, American Airlines gaining about 3% today, perhaps on the heels of the good news over the weekend that American Airlines canceled about 2,000 flights, citing weather and staffing. This is the same deja vu with Southwest. It's the weather. It's not the jab mandates. It's not our workers quitting. And they're blaming it, of course, on high winds in Dallas. So if you are a viewer from Dallas, Texas, please update us on the massive hurricane you guys are apparently having right now. Because American Airlines continue to cancel flights, even today, citing the same issue, the weather and the winds in Dallas. And then we have Deere moving higher by about 5% today. We already talked about Deere in the intro of the video. Then we have Moderna, for example, dropping down by more than 2% today. And the reason is Moderna is delaying the request for COVID vaccine in children after FDA asks for more time. We are finding out that Moderna's shot is really strong and it is eliciting a severe reaction specifically in younger people. And this is raising concerns about administering the vaccine, the Moderna vaccine, on children. We also have another notable mover in AMC moving about 5% higher today, and the reason is AMC reported that October was their best month since COVID started, so perhaps we're seeing a recovery in the movie theater attendance. I'm also looking at Discovery moving higher, and I will discuss my trade for Discovery in the charts analysis. Here's another notable mover, the ticker HUG, Harley Davidson, gaining about 9% today, and the reason is we have a deal. Shares of Harley Davidson, U.S. whiskey makers, soar as EU tariffs finally end. These are the Trump tariffs, the retaliatory tariffs that the Europeans slapped on us on motorbikes and whiskey. Here's another name moving higher, Brown-Forman, gaining about 4% today, a whiskey maker that suffered from the tariffs from the European Union. Brown-Forman was one of my Biden picks, the Biden portfolio picks. It was one of the few names that underperformed the market since the Biden election. But perhaps now that the tariffs are gone, we will see Brown-Forman and Harley Davidson all moving higher from this point on. Moving on to the charts analysis, starting with the SPY 30 minutes chart. What's going on here? We have the so-called wedge consolidation being broken to the upside, but be careful here. This could be a trap. And the reason is we had a gap and crap in the morning, and the chart of the SPY failed to close above the gap and crap candle. So if this is a trap, then the chart will move down to the wedge and perhaps break the wedge consolidation to the downside, and thus be a bull trap. The support remains at 454. You can see the action clearly in the daily chart for the continuous contract in the SPY. It is stalling for now. It is running out of gas. The move is extreme in nature. It needs to pull back. If it doesn't pull back right now, then eventually it will pull back but the pullback will be extreme and violent in nature. You gotta pull it back right now. We have many catalysts, by the way, for the pullback. The Virginia elections tomorrow. We have the bill. If we don't have a vote tomorrow, it's gonna be a problem. But we also have the upcoming statement from Jerome Powell. The likelihood is you're gonna see a lot of profit taking before the statement comes out from Papa Jerome. The support remained 4,549.5, and as you can see, the momentum indicators are highly extended, desperately begging for a pullback. When we zoom in to the futures contract, this is the 30 minutes chart. The bulls would argue, yes, we had a gap and crap in the morning, but the chart is forming a double bottom. We're going to start moving higher from this point on. On top of that, we have a double bottom followed by a bull flag, meaning the chart will break higher and it will surpass the gap and crab candle. On the other hand, the big picture, when you look at the candle, or the chart, it is forming a bear flag pattern that could play to the downside. I'm going to give this to the bears, and the reason is we have a lot of problems, a lot of speed bumps that we're about to hit, and the move is already extreme in nature to begin with. Moving on to the Qs. 30 minutes chart, what's going on here? Again, we have the wedge consolidation, and it appears that the Nasdaq is breaking to the upside, at least for now. There's nothing to see here. The sky remains the limit, specifically if giant names like Tesla and Facebook, continue to move impulsively higher based on options gambling activities. Take a look, for example, today. Even with Google down, Microsoft down, Apple down, the fact that Facebook and Tesla are up big, accompanied with some semiconductor and software names, that was good enough for the Nasdaq to climb higher. What about the daily chart for the continuous contract for the Nasdaq? Extreme move to the upside. The volume is shrinking down little by little. This is a bullish signal indicating that perhaps the chart will move higher. The problem is, I remain suspicious that this will be a bull trap, and the reason is the market has been moving higher based on algos, retail buying, and options gambling mania. All of these catalysts, all of these reasons that push the market higher have a short-term scope. The algos are going to push to a certain degree before the technicals get overextended. The retail crowd is getting in to make a quick buck. Christmas money in, out, hello, goodbye. The options gambling mania is happening for now until the implied volatility tops. The risk versus reward becomes unworthy, and then the mania stops. They have to rotate from name to name, and the game becomes more dangerous. I fear that any catalyst, any negative catalyst that will happen right now will produce a flush down candle. It could be the elections in Virginia tomorrow. It could be the failure to pass the bill tomorrow. It could be the statement coming out of Jerome Powell on Wednesday. Now, when we shift to the NDX, the big Nasdaq, this is a daily chart, of course, the bullish trend remains intact, by the way. We went down in September, reaching the trend line to the penny before bouncing higher. Now the move is becoming overextended again, and at some point the chart will have to go down and revisit the trend line once again. And so long as the trend is intact, we are in a bull market. Moving on to the IWM 30 minutes chart for the Russell 2000. What's going on here? Finally, we have the breakout. The chart exploded higher, and it moved all the way to recapture not just the 229, but now the 233 for support. The problem is the move is too extreme on daily basis. As you can see, the RSI went to the so-called overbought territory, indicating that perhaps we will see a pullback tomorrow. And that pullback could be all the way down to 229, or it could retouch 233 and find support from that point on. It consolidates for a little while. That would be the ideal bullish scenario. If we see a pullback to 233 and the chart consolidates for a little while, that will be a buy signal. Of course, we could also see buy the rumor, sell the news phenomenon, and the so-called infrastructure bill and the spending bill doesn't happen. And even if it happens, we see sell the news phenomenon. Moving on to the Dixie, the dollar index. What's going on here? It moved a little higher, but it closed at the lows of the day. The dollar will be steady for now, anticipating the statement from Jerome Powell. We know he's going to taper, but when is he going to taper? Is it going to be November or December? And by how much? Is it still $15 billion a month, or perhaps more than that? This will impact the move in the dollar. It's a game of expectations, of course. We've already pricing in $15 billion a month in tapering. Anything more than that, or perhaps raising interest rates at a faster pace to control inflation. This is what the market is not pricing for now. And if it happens, you will see the dollar moving impulsively, one way or the other. Aggressive tapering could push the dollar extremely higher. And this, of course, will not be good for, you guessed it, gold. Gold is struggling to capture the channel once again. And the resolution for this battle will be the upcoming statement from Jerome Powell on Wednesday. it will move the dollar, and therefore it will move gold accordingly. What about the 10-year yield? What's going on here? We have a loss in momentum from the RSI and the MACD indicator. Although, look at the RSI, it's curling back higher. So did we take a little bit of the air out of the latest move higher, and now the 10-year yield is about to move higher once again, creating higher highs? That certainly could be the case. Now we continue to watch the 2-year yield, because this is the shorter end of the yield curve. This is the part where the Fed has control over. And so far, since September, the 2-year yield exploded higher, gaining over 165% bottom to top. The move is becoming excessive and extreme, but it is a game of expectations. You saw what happened with the Canadian 2-year, with the Australian 2-year, all exploding higher. This will also happen if the Fed tapers and talks about raising interest rates. Any hawkish stance will add more fuel to the fire in the 2-year yield. Now, what about the TLT weekly chart? What's going on here? No update. The chart is still trading below 149. The momentum indicators are still weakening, and until we have Wednesday, the statement from Jerome Powell, we have more clarity on what's going to happen with the monetary policy and the tightening. We're not going to have a resolution one way or the other. We have bets, people buying calls on the TLT, buying puts on the TLT, doesn't matter. All speculation for now until we have clarity. I'm not going to conduct a trade ahead of time. We don't have any clarity. Moving on to the VIX 4-hour chart. What's going on here? The chart for the SPY from a daily perspective appears to be topping, appears to be running out of gas, which suggests that perhaps the VIX will pop higher. The problem is we deal with what we have right in front of us, the technicals that we have right in front of us. When we look at the MACD indicator from a 4 hours perspective, this has been an accurate pattern going all the way back till June, perhaps before that. Every time we have a crossing, a negative crossing in the MACD, creating red impressions in the histogram, the VIX drops down and the SPY pops higher. So looking at the MACD alone, the suggestion is the VIX already topped and it will pull back all the way to 15 and the SPY will move higher. Now you have to bear in mind the wild cards, the Virginia elections, the bill, Jerome Powell. All of these will move the market one way or the other. The technicals present one opinion, one view of what's going on in the market right now. The fundamentals, the news, the psychology offers another perspective. Moving on to Apple daily chart. What's going on here? Nothing is going on. Still consolidating between the support of 145 and the resistance of 150. The likelihood is Apple is not interesting anymore. After earnings, the reaction is meh. It's okay, but not by much. The growth is actually shrinking quarter over quarter, but perhaps they do have the catalyst for the upcoming pop in the iMob. And here it is, the iCloth. Charging $19 for a piece of cloth about the size of 2 stacked dollar bills is bold even by Apple standards. Even so, the price has not stopped Apple fans from rushing to be early adopters. Wow, the iCloth, that's the future, bro. It's gonna take Apple to the moon. Speaking of the moon, here comes Tesla, daily chart. Anything to look at here? Nothing at all. The volume is actually exploding higher. It is reaching the peaks from last week. Again, every Monday we have a pop. They're stampeding on call options. They're going to continue to do so. They went from 900 to 1,000 to 1,100 to 1,200. And tomorrow they're going to go to 1,300. Until the implied volatility tops and the risk versus reward becomes not worthy anymore. You pay a lot for premiums and the stock pops higher, and you only make 50%. It's not worth it. Until we get to that point, the stock will continue to be in la-la land. And here is a weekly chart for Tesla. All of the indicators, the RSI and MACD, are overly extended. We have a vertical move higher. We have seen these moves before in Tesla, by the way. Not as extreme as this latest move. And people have wild assumptions, by the way. They're talking about an upcoming Tesla stock split as if that's going to add value to the stock. They're buying ahead of time. Whatever explanation floats your boat, go ahead. But I know the mechanics and I know what's moving the stock higher, and it is the options gambling mania. Moving on to tulips, BTC. What's going on here? We're taking a little bit of air out of the bubble. The MACD, the RSI are cooling off. Yet the stock is not, or the chart of BTC is not flushing down. This is the good news. It is waiting and waiting and waiting, asking for buyers. Any buyers? Any buyers? If the buyers don't show up, then the chart goes down to the support 55,300. No buyers, then it flushes down more. But the likelihood is we have a lot of energy here in the crypto market. We have solid belief from some that cryptos are indeed a hedge against inflation, specifically Bitcoin. Forget about the meme coins. They're talking about Bitcoin. If more people believe that it is a hedge against inflation, then it will be a hedge against inflation, until it's not, of course. And by the way, if you made a lot of gains on BTC or any tulip, don't brag about your gains online, because you could end up being kidnapped. Some teenagers are making a fortune trading Bitcoin. One even got kidnapped because of his success. And that leads us to Shiba, not moving at all. It is still in the debate zone. We have support, but it needs more energy. It is asking right now, any buyers, any buyers, any buyers. Well, guess what? The buyers are distracted by other tulips and other manias. Therefore, Shiba is now, at least for now, Shiba is for boomers. It's already too old. Perhaps they're moving back to AMC because AMC is popping higher. We had the so-called saucer bottoming, followed by a struggle at around the resistance of 36.5. Back and forth, and eventually AMC managed to break higher, above the resistance of 36.5. This is the good news. We have a bull flag pattern. If the energy continues, then AMC could move higher. And of course, you already know the news. AMC says October was the best month for ticket revenue since the pandemic. Now, if you are serious about the movie theater business, the comeback of movie theaters, I disagree, of course. I think it is a dead business, but anyways, you might want to buy Cinemark stock. It offers a better valuation and a better entry point than AMC. And here are some bonus charts. Let's start with Facebook. This is a daily chart, of course. If Facebook pops higher and it reclimbs the trend line and it closes the week above the 200 days moving average, then you want to buy Facebook. However, if Facebook reverses and it fails to climb the trend line back and it closes the week below the 200 moving day average, then we get a massive problem here. Run for the hills. Then we have another chart, a weekly chart for the ticker LAZR. This is for Luminar. I bought some calls on Luminar. I believe that the negative momentum is topping and it is paving the way for the bullish momentum to creep back in and push the chart higher. We have a lot of LiDAR stocks, by the way, but Luminar remains, at least for now, the go-to name if you're betting for LiDAR technology, at least for now. The valuations don't make sense at all. The stock remains elevated in valuations terms. However, from a technical perspective, the stock is overbeaten and oversold, suggesting that perhaps we will see a reversal, a pop higher, a rebound, whatever you want to call it, doesn't matter to me. And therefore, I'm playing this one via call options. If you're looking for some fundamental analysis, you can read this article. It says, Tesla's safety pain is Luminar's gain. You should expect LAZR stock to stay hot as Tesla's safety probe intensifies. And the last chart of the day is for the ticker DISCA. This is for Discovery. This is a weekly chart, of course. After the Bill Wong Archegos disaster, the stock flushed down and it has no fans. It is not receiving any love at all, even though it remains a fantastic business, a growth monster in the streaming arena, yet unbeloved by market participants. So the reason is we have the sour taste in our mouth due to the Archegos disaster, but the name is about to report earnings this week. I do believe that you will be stunned by the growth in subscribers for Discovery's streaming service, and therefore I'm buying calls on Discovery. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Nothing significant at all. We have home ownership rate, but we're all watching whether we're going to have a vote or not on the so-called bill. We're also watching the Virginia elections, which will have severe implications on the agenda of Joe Biden, because if the Republican win, again, Virginia is insignificant in the grand scheme of things, but the psychology and the sentiment is important. If the Republican wins, then this will embolden Joe Manchin and his allies within the Democratic Party to become even more stubborn, and this will force the so-called progressive wing of the party and President Joe Biden to compromise even more. The market is in conflict. One side of the market wants the insane spending on steroids. The other side of the market doesn't want the insane spending on steroids, and the reason is it will push inflation higher, prompting the Fed to tighten abruptly. Lastly, what about the earnings calendar? What do we have in the earnings agenda tomorrow? We have British Petroleum in the morning. We also have Pfizer in Martin Marietta. After the bell, we have Qualcomm, T-Mobile, Zillow, the Frat House, Activision, and another consumer staple giant, Mondelez. Today, we got NXP and Clorox. And here we have another one. Clorox, another consumer staple giant, who's also raising prices on end consumers, meaning you and I. Welcome to hyperinflation. This is all I got for you for now, folks. Thank you for watching, thank you for listening, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.